It's 2021, and your coworker just made $40,000 on some cryptocurrency you've never heard of. Your neighbor turned $5,000 into $50,000 trading meme stocks. And you? You're sitting there with your boring index funds that went up a measly 18% for the year, feeling like the biggest idiot on the planet. So what do? You open a Robinhood account, you start watching YouTube videos about options trading, and within 6 months, you've lost $8,000. Sound familiar? My name is John, and I spend way too much time thinking about why smart people make catastrophically stupid decisions with their money. If you're someone who knows they should be investing, but you're paralyzed by all the conflicting advice out there, or if you've already started investing but you keep second-guessing every single decision you make sure to hit that subscribe button and give this video a thumbs up if this helps you out. Because here's the thing, and I mean this. The stock market is probably the only place where people actively ignore the advice that actually works in favor of advice that sounds exciting. And today, I'm going to give you 5 rules for successful stock investing that have worked for decades, that will continue to work for decades, and that you're probably going to want to ignore because they're boring. But if you can actually follow these 5 rules, you'll beat about 90% of investors out there, including most professionals. Let's get into it. Okay. Rule number 1. Time in the market beats timing the market. And I know you've heard this before. Everyone says this. But here's what most people don't realize. The math behind this isn't just slightly in favor of staying invested. It's overwhelmingly in favor of staying invested. Look, Fidelity did a study, and this is one of my favorite statistics in all of finance. They looked at their own investors from 2003 to 2013. And they wanted to know, who performed the best? And the answer is going to blow your mind. The best performing investors were either dead or had forgotten they even had an account. I'm serious. The people who literally did nothing, because they died or because they forgot their password or whatever, they outperformed active traders by significant margins. Why? Because they didn't panic sell during the 2008 financial crisis. They didn't try to time the COVID crash in 2020. They just stayed invested. Here's the math that makes this really clear. According to JP Morgan's analysis of the S&P 500 from 1999 to 2018, so a 20-year period, if you stayed fully invested the entire time, your average annual return was 5.6%. Not amazing, but solid, right? But here's where it gets really interesting. If you missed just the 10 best days in the market during those 20 years, just 10 days out of roughly 5,000 trading days, your return dropped to 2.4%. If you missed the best 20 days, you actually lost money. Your return was negative. And here's the thing that drives me crazy. Those best days almost always happen right after the worst days. They happen during crashes. They happen when everyone's panicking. When CNBC is running segments about the end of the financial system, that's when the biggest gains occur. So when you try to time the market, when you sell because things look scary, you almost guarantee that you're going to miss the recovery. You're going to be sitting in cash, waiting for the right time to get back in, and by the time you feel comfortable, the market's already up 30%. Now you might be thinking, but John, what if I just avoid the worst days too? What if I could just sidestep the crashes? Great question. Terrible strategy. Because here's the reality. You can't predict the worst days before they happen. Nobody can. Not you, not me, not the guy on TV with the expensive suit and the Bloomberg terminal. A study by Charles Schwab found that even if you had perfect bad luck, like the worst timing, humanable, where you invested a lump sum right before every single market crash from 1979 to 2020, you'd still end up with more money than someone who tried to time the market and sat in cash waiting for the perfect moment. Let me give you a concrete example. Let's say you had $10,000 to invest in 2000, right before the dot-com bubble burst. Literally the worst possible timing. If you just held an S&P 500 index fund and never touched it, by the end of 2020, you'd have about $32,000. Even after living through the dot-com crash, the 2008 financial crisis, and the COVID pandemic. But if you tried to time the market, If you pulled out during the scary times and waited for things to calm down, most people would be lucky to have $20,000. Some would have less than they started with. The psychological shift you need to make here is this. You have to stop thinking of volatility as risk and start thinking of it as the price you pay for returns. The stock market goes down sometimes. That's not a bug, it's a feature. That volatility is exactly why stocks return 10% per year on average, while savings accounts return basically nothing. Rule number 2. Diversification isn't just a good idea, it's mathematics. And I don't mean it's a good idea that happens to be supported by math. I mean the math literally requires it if you want to manage risk intelligently. Here's the thing most people get wrong about diversification. They think it's about not putting all your eggs in one basket, which, sure, fine, that's the kindergarten version. But the real reason diversification works is because of something called non-correlated returns. Let me explain this with a story. Let's say you have two friends who own businesses. Friend A owns an ice cream shop. Friend B owns an umbrella shop. Now, on sunny days, the ice cream shop does great and the umbrella shop does terrible. On rainy days, it's the opposite. Umbrellas fly off the shelves and nobody wants ice cream. If you invested all your money in just the ice cream shop, your returns would be super volatile, right? Great when it's sunny, terrible when it rains. But if you invest 50% in the ice cream shop and 50% in the umbrella shop, you have much more consistent returns regardless of the weather. That's non-correlation, and in the stock market, this effect is incredibly powerful. Here's some actual data. According to research from Vanguard, a portfolio of just one stock has a standard deviation, that's a measure of volatility, of about 49%. That's insanely volatile. But as you add more stocks, something magical happens. With 25 stocks, your volatility drops to about 32%. With 100 stocks, it's down to about 20%. And here's what most people don't realize. Most of that benefit comes from the first 20 or 30 stocks. After that, you get diminishing returns. This is why index funds are so brilliant. You get exposure to 500 or even 3,000 companies, and your volatility is way down while your expected returns stay roughly the same as the market average. But people don't do this. You know what they do instead? They buy 5 stocks. They buy Apple because everyone knows Apple. They buy Tesla because Elon Musk is a genius. They buy whatever stock their friend told them about at a barbecue. And then they wonder why their portfolio swings up and down like a roller coaster. Look, I get it. Buying an index fund feels boring. It feels like you're admitting you're not smart enough to pick winners. But here's the reality that's going to sting a little. You're probably not smart enough to pick winners. Neither am I. Neither are most professional fund managers. A study called the SPIVA scorecard, which stands for S&P Indices versus Active, tracks how actively managed funds perform compared to their benchmark indices. And the results are devastating for active management. Over a 15-year period, 92% of large-cap fund managers underperformed the S&P 500. 92%. These are professional investors with teams of analysts, with access to company management, with sophisticated computer models. And 9 out of 10 of them can't beat the index. What chance do you have picking individual stocks? Now, I'm not saying you can never own individual stocks. If you want to take 5% or 10% of your portfolio and pick some companies you believe in, fine. That can actually make investing more engaging. And if it keeps you invested long-term, it might be worth it. But your core portfolio, the money you're actually counting on for retirement, that should be diversified. Broadly diversified. The psychological shift here is humility. You have to accept that you don't know which companies are going to be the next Amazon, and that's okay. You don't need to know. You just need to own a little piece of all of them. Rule number 3. Costs are the only thing you can control, so control them ruthlessly. And this is where people hemorrhage money without even realizing it. Here's the thing. You can't control what the market does. You can't control whether we're going into a recession. You can't control interest rates or inflation or whatever chaos is happening in Washington. But you know what you can control with absolute precision? How much you pay in fees. And most people have no idea how much fees are costing them. Like, no idea. Let me give you an example that's going to make you angry. Let's say you invest $100,000 and it grows at 8% per year for 30 years. If you're paying a 1% annual fee, which is pretty common for actively managed mutual funds, you'll end up with about $760,000. If you're paying a 0.1% fee, which is what you'd pay for a low-cost index fund, you'll end up with about $987,000. That's a difference of $227,000, over $200,000, just from fees. Now you might be thinking, come on, John, 1% doesn't sound that bad. That's just 1 penny on every dollar. And this is exactly the trick. 1% sounds tiny, but compounded over decades, it's absolutely devastating. Here's what really gets me. That 1% fee isn't 1% of your returns. It's way worse than that. If the market returns 8% and you're paying 1% in fees, you're not keeping 7%. You're actually giving up 12.5% of your total returns. Think about that. You're handing over more than 1/8 of all the money your investments earn to someone else. And for what? According to that same SPIVA data I mentioned earlier, you're probably getting worse performance than an index fund, so you're paying more to get less. It's like paying extra for a slower internet connection. Look, the financial industry has spent billions of dollars trying to make you think you need their expensive products. They've got guys in suits on TV talking about their proprietary research and their sophisticated strategies. They've got glossy brochures with charts that go up and to the right. They've got advisors who'll meet you for coffee and make you feel special. But here's the reality. For most people, the best investment strategy is also the cheapest. Low-cost index funds. That's it. Boring, simple, effective. Now, there are situations where paying for advice makes sense. If you need help with tax planning, estate planning, comprehensive financial planning, yeah, that can be worth it. But you should be paying for that advice directly, not through hidden fees embedded in your investments. The psychological shift here is skepticism. Every time someone wants to charge you a fee, you need to ask, what am I getting for this? And if the answer is the potential for higher returns, you need to see proof. Not a hypothetical chart. Real, actual performance data over long periods. Rule number 4. Asset allocation matters way more than stock picking, and it's not even close. Here's something that's going to sound crazy. According to a famous study by Brinson, Hood, and Bauer, and this has been replicated multiple times, more than 90% of your portfolio's volatility and long-term returns come from your asset allocation, not from which specific investments you choose. Let me say that again because it's important. Whether you retire rich or poor is mostly determined by how you split your money between stocks, bonds, and other assets. Not whether you pick Apple or Microsoft. Not whether you buy this mutual fund or that ETF. The big decision, the one that actually matters, is your overall allocation. And most people completely ignore this. Let me give you a concrete example. Let's say you're 35 years old with $50,000 to invest. You've got two choices. Option A, you put 100% in stocks. You pick all the right stocks. You're a genius. You beat the market by 2% per year. Option B, you put 80% in stocks and 20% in bonds. You just buy index funds. You get average returns. Which one do you think does better over 30 years? Option B. The properly allocated portfolio beats the genius stock picker in almost every realistic scenario because the stock picker, with 100% in stocks, is taking on so much volatility that they're likely to panic and sell during a downturn. Meanwhile, the balanced portfolio has bonds that cushion the blow during crashes, making it way easier to stay the course. This is where it gets really interesting. The right asset allocation isn't the one that maximizes your returns. It's the one you can actually stick with when the market drops 40%. Because here's what happens in real life. People create these aggressive portfolios when the market's doing well. They're 100% stocks, maybe even leveraged. They're feeling great. They're beating their friends. And then the market crashes, and they completely lose their nerve. They sell everything at the bottom, and sit in cash for years. I saw this happen over and over in 2008 and again in 2020. People with supposedly high risk tolerance who'd been bragging about their returns suddenly couldn't handle seeing their portfolio down 30%. So they sold, and they missed the entire recovery. The bond allocation, that boring 20% or 30% that seems like it's just dragging down your returns, that's your psychological safety net. That's what keeps you invested when everyone else is panicking. Now, how do you figure out the right allocation for you? There's an old rule of thumb. Subtract your age from 110, and that's the percentage you should have in stocks. So if you're 30, you'd be 80% stocks and 20% bonds. If you're 60, you'd be 50-50. Is that perfect? No. It's a guideline. Your actual allocation should depend on your goals, your time horizon, your stomach for volatility, your income stability, and a bunch of other factors. But it's a decent starting point. Here's what I want you to understand. You can be wrong about individual stocks and still get rich if your allocation is right. But you can be right about individual stocks and still fail if your allocation is wrong, or if you panic and sell at the wrong time. The psychological shift here is recognizing that investing isn't about being smart or right. It's about being disciplined and consistent. It's about building a portfolio you can live with through good times and bad. And that brings me to rule number 5, which might be the most important one. Ignore the noise. Look, we live in an era where you can check your portfolio balance 50 times a day, where financial news is on 24/7, where every market move has 10 different experts explaining 10 different reasons why it happened and what it means for the future. And all of it, is terrible for your returns. Here's a study that absolutely blew my mind when I first read it. Researchers at UC Berkeley looked at the trading records of 35,000 households from 1991 to 1996. They wanted to know, does active trading improve returns? The answer was not just no. It was hell no. The investors who traded the most, the ones who were most engaged, reading the news, actively managing their portfolios, they earned an average return of 11.4% per year. The investors who traded the least, the ones who basically ignored their accounts, earned 18.5% per year. Think about that. The people who did less, who paid less attention, who were less sophisticated, they beat the active traders by more than 7 percentage points per year. Over a decade, that's the difference between turning $100,000 into $300,000 versus turning it into $450,000. Why? Because every time you trade, you're making a bet. You're betting that you know something the market doesn't. And statistically, you're probably wrong. Even if you're right about the direction, you're probably wrong about the timing. And even if you're right about both, you're paying trading costs and taxes that eat away at your returns. But here's the real problem with all this noise. It makes you feel like you need to do something. The market drops 2%, you feel like you should sell. Some analyst upgrades a stock, you feel like you should buy. Bitcoin's up 50%, you feel like you're missing out. This is called action bias, and it's one of the most expensive biases in investing. Let me tell you what the noise wants you to forget. Over the last 100 years, the stock market has returned about 10% per year on average. Some years it's up 30%. Some years it's down 30%. But if you just stay invested through all of it, you get that 10%. That's it. That's the whole secret. Buy a diversified portfolio of low-cost index funds, invest consistently, and ignore everything else. But that's boring, right? That doesn't make for good TV. That doesn't give you something to talk about at parties. So the financial media has to create the illusion that there's always something important happening that requires your attention. Here's my challenge to you. For the next month, don't check your portfolio. Don't watch financial news. Don't read articles about what the Fed's going to do or whether tech stocks are overvalued. Just don't. I promise you two things will happen. First, your portfolio will be fine. It'll go up some days, down some days, and the world will keep spinning. Second, you'll feel so much less anxious about money. Because here's what most people don't realize. The stress of investing doesn't come from the market. It comes from paying attention to the market. The market's been volatile forever, but people weren't checking their portfolios on their phones 50 times a day in 1985. They weren't getting push notifications about market crashes. They invested, and they lived their lives. The psychological shift here is trust. You have to trust that the market will do what it's always done, go up over long periods, despite short-term chaos. You have to trust your plan instead of constantly second-guessing it. Okay, let's bring this all together because I know I've thrown a lot at you. These 5 rules: time in the market, diversification, low costs, asset allocation, and ignoring the noise. They're not sexy. They're not going to make you feel like a genius. They're not going to give you stories to brag about. But here's what they will do. They'll make you rich. Not overnight. Not in a way that feels exciting. But steadily, predictably, over decades. And the beautiful thing? This stuff actually gets easier as you go. The hardest part is the beginning, when you're trying to fight all your instincts that tell you to do something more exciting. But once you've built the habits, once you've automated your investments, once you've trained yourself to ignore the daily noise, it basically runs on autopilot. I want to leave you with one final thought. The stock market is one of the greatest wealth-building tools ever created. It's allowed ordinary people with ordinary incomes to retire as millionaires. But it only works if you let it work. Every time you panic sell, every time you try to time the market, every time you chase the hot stock or pay ridiculous fees or change your strategy based on what some guru said on TV, you're sabotaging yourself. You're choosing short-term excitement over long-term wealth. Don't do that. Follow these 5 rules. They're boring. They're unsexy. They've only worked for every single successful long-term investor in history. And hey, if this video helped you, if you're feeling more confident about your investing strategy, or if you learned something new, make sure you hit that subscribe button because we're going to keep talking about this stuff. We're going to keep cutting through the nonsense and focusing on what actually works. Now get out there and start building wealth. Your future self will thank you.